Our Trust and Estates webinar, Pivotal Philanthropic Stages, a look at the life cycle of a foundation, sponsored by Foundation Source and produced by Trust and Estates and wealthmanagement.com. I'm Susan Lipp, Editor-in-Chief of Trust and Estates, and I'll be your moderator today. In a moment, I'll be turning things over to our speaker, but first let me explain how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. Clicking on these icons will allow you to open and close widgets on your screen, but won't remove you from the event. A copy of today's slide presentation is available for download on the resource list widget. This webinar has been accepted for 1 CE credit hour towards the AEP designation program. The live broadcast of this event has been approved for 1 CFP Board CE credit hour. Investments in Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the resource list widget. For those attorneys in the audience getting a continuing legal education credit, please listen for a code word that will be stated at some point during the webinar. To get your CLE credit, attorneys must put that code word into the survey that appears at the end of the webinar. Attorneys must also include their bar number and state of practice to receive the CLE credit. However, you can open the survey at any time by clicking on the survey widget on your screen. Again, please note that the code word pertains only to attorneys getting CLE credit. We welcome questions about our topic and will answer as many as we can following the presentation, but feel free to submit yours to the queue at any time. Just type it into the Q&A window on the left-hand side of your screen and hit the submit button. Please be aware that today's session is being recorded and will be available for on-demand viewing following the event. Simply log on using the same URL that you're using today. So now let me introduce today's speaker, Jeffrey Haskell, who is Chief Legal Officer at Foundation Source. And you can find more information about Jeffrey by clicking on the speaker bio widget at the bottom of your screen. So with that, Jeffrey, I'm going to turn things over to you.
Okay. Thank you, Susan. And thank you all for joining me here today. For this session, we'll be covering a number of key points and considerations during each phase of a private foundation's life cycle. And we'll also talk about a foundation's ability to compensate its board members. Well, once you've decided to move forward with establishing a private foundation, one of the very first decisions you'll need to make is which legal form it should take. As you can see, there are a number of differences between a foundation formed as a trust and one formed as a corporation. However, for the most part, it's certainly possible to bring them roughly into parity with each other. Well, by default, trustees are generally considered to be held to a higher fiduciary standard than the directors of a corporation, which may steer some foundations towards the corporate form. However, under the trust law of many states, a trustee's fiduciary standards may be brought into rough alignment with those applicable to the director of a corporation. One key point that deserves analysis when applicable is which form may be a better fit for a private foundation that expects to hold investments that'll generate significant amounts of unrelated business taxable income, or UBTI. While passive income like interest, rent, and dividends is taxed at the nominal 1.39% excise tax rate for private foundations, UBTI is taxed at higher for-profit tax rates. Corporations are taxed at a flat rate of 21% for ordinary income, which is much lower than the highest rates applicable to trusts. But that's not the whole story. A foundation set up as a corporation can offset up to 10% of its UBTI with grants to U.S. charities. While trusts generally have higher tax rates with respect to ordinary UBTI, they have a lower tax rate on capital gain UBTI. Plus, trusts can offset up to 50% of the UBTI with grants to U.S. charities. While that whopping deduction has the potential to slash a trust's effective tax rate, the trust would actually need to make enough charitable grants to achieve that reduction of its effective tax rate, which may not always be practical or possible. Bear in mind that grants to individuals, expenditure responsibility grants to non-charitable organizations, and even grants to foreign charities that otherwise are the equivalent of U.S. charities may not be taken as charitable deductions to offset UBTI. Also, some states have their own UBI. If a foundation has UBTI that's not sourced to a particular state, like unrelated debt-financed income that arises from leveraged investments, some organizations source that UBTI to their state of domicile. In the case of a corporation, that will be their state of incorporation. Some states, like New York and California, impose an unrelated business income tax that stacks on top of the federal one. Other states, like Delaware, don't. One final point: while a corporation can be incorporated and can therefore be domiciled pretty much anywhere, it's not a free-for-all for a trust. Its situs is tied to the state where the trust has a nexus, which will normally be a state in which one or more of the trustees reside. If the trustees are geographically dispersed across multiple states, and one of those states doesn't impose an unrelated business income tax, tying the foundation's situs to that state would make sense. And that assumes, of course, that there's no physical office or programs carried out in another state that would create a stronger nexus to the trust. And that's not an unreasonable assumption, because non-operating foundations typically make grants and don't run their own programs. Well, once you've settled on a legal form, there are a number of other decisions that need to be made that'll impact the organization and drive the terms of its governing instrument. For example, although the foundation is a Section 501c3 organization that must be operated exclusively for charitable purposes, you have the option of defining the purpose very broadly, in which case the foundation can support a wide range of charitable purposes, or the purpose can be very narrowly drawn, such as to support cancer research. For foundations formed as corporations, it's well understood that their governing instruments can be amended by future boards. Therefore, locking in the foundation's purpose to something like cancer research, something that might be near and dear to the heart of the founder, can't really be accomplished by specifying that purpose in its certificate of incorporation. On the other hand, a trust's governing instrument can't be revised without court and sometimes even the Attorney General's approval, unless the trust's terms expressly permit its revisions. I mentioned that a rough parity can be reached between corporations and trusts, and while it's true that a corporation's certificate of incorporation is in fact subject to future revision, a restricted gift to the foundation, one that can be used only for a specific purpose, like cancer research, is generally binding, even if a corporation's governing instrument otherwise permits the foundation to engage in a very broad range of charitable activities. You'll also need to consider whether the foundation should exist in perpetuity or only for a specified span of years. And another consideration for foundations that are formed as corporations in particular is whether the corporation should adopt a self-perpetuating board model where the board members appoint or remove themselves, or whether the foundation would be better served by a membership structure where one or more members appoint and remove the directors. Now, either an individual or an entity can serve as a member, making this structure especially attractive for corporate foundations and for founders who don't plan to serve on the board of directors themselves, because this structure allows the member to retain ultimate control over the foundation by controlling the board's composition. Well, now that we have an idea of what formation involves, let's take a look at some issues to consider as the foundation starts its operations. As the foundation begins its journey, it'll need to track and maintain an awareness of various issues to avoid compliance tax and other concerns. It may consider directors and officers insurance, or D&O insurance, to those serving on the foundation, although in my experience, only a small percentage of foundations carry such insurance, especially smaller foundations. But on the other hand, doing so can sometimes help the foundation recruit qualified individuals that otherwise wouldn't consider serving on the board. From a compliance standpoint, it'll be important to continuously track the foundation's substantial contributors and other individuals and entities that are considered insiders with respect to the foundation. Doing so will help the foundation avoid running afoul of the IRS's self-dealing rules, which generally prohibit transactions between a foundation and its insiders with limited exceptions. It'll also help avoid violations of the excess business holding rules, which limit the combined holdings that a foundation and its insiders or disqualified persons can have in an active business. The foundation also should be on the lookout for possible cash flow challenges, and those can arise when the bulk of its portfolio is composed of non or low income producing illiquid investments. In that case, the foundation's investments can't be relied upon to provide enough cash flow to cover the foundation's ongoing operating expenses, like its annual minimum 5% payout requirement and its tax bills. And lastly, the foundation must keep in mind that any assets other than cash and publicly traded securities require ongoing annual valuations in order to prepare the foundation's annual return. That said, a qualified appraisal of real estate can last for up to 5 years. Now let's take a look at the two main types of private foundations: corporate foundations and family foundations. When a for-profit company decides to start its own private foundation, it's often run by existing employees of the corporate parent, rather than by a group of individuals that were hired by the foundation to work exclusively for the foundation. Because these individuals serve dual roles, it's important that they make clear in which capacity they're acting when communicating with those outside the foundation. Suppose, for example, that someone wearing both the foundation's and the company's hats committed to buying a table at a charity's fundraising event with the intention of giving those tickets away to the company's top clients. Suppose further that the charity mistakenly invoiced the foundation for those tickets. If the foundation were to pay that invoice, a self-dealing violation could result from the company's use of the tickets for its own benefit. Another major pitfall is using the corporate foundation's assets to drive business opportunities for the parent company. That's a pitfall because under the IRS's self-dealing rules, a violation could result if any benefit to the company from the foundation's assets or activities is more than merely incidental. And if self-dealing penalties are due, they be paid by the self-dealer, here the parent company, not by the private foundation. Another understandable misconception is thinking that the company can charge the foundation rent, provided that the rent charged is at or below market rates. Unfortunately, though, self-dealing would result from the foundation's payment of any rent to the company or any other insider. That said, a foundation may be able to pay third-party vendors for the foundation's share of expenses that's attributable to its use of the rent-free space provided by the company, provided that the payments are made directly to the third-party vendor and the method of determining the foundation's share of expense is reasonable. For example, a percentage of square footage relative to the overall space. However, sometimes the self-dealing rules can be counterintuitive. Even transactions that unquestionably benefit the foundation can sometimes result in a self-dealing violation. For example, if the company were to make a loan to the foundation at below market rates, self-dealing would result even though the foundation would be getting a better deal, a sweetheart deal, better than it can get from any other lender at arm's length. That's why it's of utmost importance to approach any transactions between the funding company and the foundation with caution. Now let's talk a little bit about family foundations. Perhaps the most familiar type of private foundation is the family foundation. Here, the foundation is typically funded by one or more members of the same family, and the board is mostly, if not entirely, composed of family members as well. In fact, Some make it a point to make family membership an eligibility criterion for board service, and they put that right in the governing instrument. Even so, the foundation likely will need to decide whether the spouses of family members are considered family for these purposes. This could be a particular concern in the event of a divorce. Similar concerns can arise regarding the status of stepchildren. Depending on the circumstances, there may be more than one generation of the family serving the board at the same time. While this can be considered a wonderful opportunity to get both the younger and older members of the family together and can strengthen their bond through philanthropy, but differing opinions and perspectives among the generations can sometimes lead to conflict. Unlike corporate foundations, a family foundation may be less likely to have an accountant or an investment advisor on hand and may need to bring in outside professionals unless someone serving on the foundation is already experienced or skilled in those areas. Now let's take a look at some key considerations regarding the foundation's operations. Aside from the more informal categories of corporate or family foundation, there are two formal classifications available to foundations under the Internal Revenue Code, and that is the operating and the non-operating or grant-making foundation. Now, provided that an organization qualifies as a 501c3 charitable organization, the default classification under the IRS rules will be as a non-operating or grant-making private foundation. To obtain any other classification, whether it be operating or even be public charity, an entity must actively demonstrate that it meets the applicable requirements. The benefit of obtaining classification as an operating foundation is that the entity can offer donors more favorable charitable contribution deductions for any donations it receives. As a practical matter, it can make the difference between a fair market value charitable deduction versus a deduction that's limited to basis. The main difference between the two types of foundations is that non-operating foundations generally fund projects and programs run by other organizations. By contrast, an operating foundation must be substantially and continuously involved in running its own charitable projects or programs. Now, to meet the requirements for operating foundation status, the foundation must meet certain tests, specifically an income test, as well as one of three other tests known as the assets test, the endowment test, and the support test. The foundation must satisfy these tests for any 3 years during a moving 4-year window, or by looking at all 4 years in the aggregate. The 4-year window consists of the tax year in question and the 3 immediately preceding years. Regardless of whether a foundation seeks classification as an operating or non-operating foundation, every foundation can benefit from a focused mission statement. Having a mission statement helps the foundation focus its grant making. Without it, foundations can end up giving smaller grants to numerous diverse causes without making any real meaningful impact on any particular cause. I've heard that referred to as the spray and pray approach. You spray the money around and pray it'll have an impact. Failure to craft a mission statement can also lead to conflict among board members, who may each be seeking to support different causes. A clear mission statement can also make clear to the community of potential grant recipients what the foundation's interests, goals, and limits are, and can therefore cut down on the number of unsolicited requests for grants in which the foundation isn't interested. And lastly, a clear mission statement can make the foundation's board members more likely to contribute to the foundation because they'll have a clear idea of how the funds are supposed to be used. It's always a good thing to have board members contribute to the foundation, as they're more likely to feel invested and interested in monitoring outcomes and results. Now, let's go over some key considerations regarding the foundation's governing board. The board is the governing body of a nonprofit. The members of the nonprofit board focus on high-level strategy, oversight, and accountability of the organization. This contrasts with the officers, employees or managers who oversee the nonprofit's day-to-day operations. With a corporation, the board is typically responsible for appointing and removing the organization's officers. Whether a corporation or a trust, board members have fiduciary duties with respect to the organization they serve. Three types of fiduciary duties applicable to directors of a corporation, which are nearly identical, by the way, to the duties applicable to trustees, are: first, you have the duty of care. Directors are expected to take care of the foundation by ensuring prudent use of all assets, including facilities, staff, and goodwill. Second, you have the duty of loyalty. The directors must place the foundation's interests ahead of their own personal interests and act at all times in the foundation's best interests. Generally, a foundation's conflict of interest policy requires that those serving on the foundation disclose any actual or potential conflicts. Note that it's important to avoid not only conflict, but even the appearance of a conflict. And third, we have the duty of obedience, which means that the directors are to ensure that the foundation obeys applicable laws and regulations, follows its own bylaws and policies, and adheres to its stated mission. When it comes to board size, states have varying minimums. For example, Delaware requires only a single director, while California requires at least 3. However, most states don't place a cap on the number of directors that a corporation may have. Therefore, in determining how many members the board should have, it typically comes down to practical considerations, including setting the number at an odd number to avoid deadlocks and taking into account the amount of work expected to be required of the board on a regular basis. As for selection, the founder will want to consider which skills and personality traits will be necessary or desirable for board service, and then consider which family members, friends, advisors, or others fit the bill. Some foundations formed as corporations impose term limits for officers so that family members can rotate through different positions on the foundation. Very often, with family foundations with young children, the creation of a junior board may be a great idea. Although not technically directors, junior board members might assist in identifying charities for grants or researching grant requests, making them feel like they're making meaningful contributions to the foundation's work. Succession protocol may be set in the foundation's governing instrument. For a trust, one or more particular individuals may be designated as successor trustees, whereas with corporations, successor directors may be designated in a board resolution. Next, let's take a look at some administrative issues that foundations need to be aware of. Another important aspect of private foundation operations is ensuring that the foundation has clearly articulated written policies in place. These policies are established by the board and serve to guide the foundation's day-to-day operations. Without formal written policies, things can quickly go off the rails, and serious conflicts can ensue from a lack of clear guidance on how the foundation should be run. For example, without a formal expense reimbursement policy in place, one particular officer might think he's entitled to reimbursement for hotel costs for a foundation site visit, even though the hotel rates may be well beyond what most of the board members consider reasonable. And there'd be nothing to point to that would show that choosing to stay at the Waldorf as opposed to the Hilton on the foundation's dime was inappropriate. Also, the foundation will need to ensure early on that it has an accountant who's well-versed in Form 990-PF, which is the annual information return filed by a private foundation, as opposed to tax returns for individuals or businesses. That's because there are many important differences between the forms filed for those taxpayers and the 990-PF filed for a foundation. One example is the concept of having to classify virtually every expense as either a qualifying distribution, meaning it'll be an expense that'll count towards satisfying the foundation's annual 5% payout requirement, as opposed to an investment expense that'll offset investment income and reduce the foundation's tax liability. And then, of course, there's knowing how to calculate the 5% annual payout requirement, just to name a couple of differences. Now, aside from engaging an experienced professional to prepare the foundation's filings, the foundation will need someone to track compliance with the annual minimum payout requirement and keep on top of the foundation's federal and state filings and the calculation and payment of any required estimated taxes. Now, let's take a look at some of the things that a foundation will need to keep track of or consider on an ongoing basis. Once a family or business makes a decision to house their philanthropy in a separate legal entity, such as a private foundation, it becomes crucially important not only for staff to educate themselves on the applicable IRS rules, but also to have in place some sort of game plan for ongoing compliance monitoring, as the rules aren't always intuitive. After all, even certain transactions with insiders that benefit the foundation can result in a violation. As I mentioned earlier, foundations need to be cautious about engaging in financial transactions with an insider to avoid any self-dealing concerns. Foundations must also be mindful of the IRS's excess business holding rules, which limits the percentage of ownership in a foundation that a foundation, in combination with its insiders, may have. And again, that's tricky because insiders aren't necessarily only those serving on the foundation, and maybe family members who are not serving. So being aware of what the foundation has in a particular private enterprise, as well as family members and insiders serving on the foundation, is very important. Lastly, certain grants and expenses can result in violations known as taxable expenditures if they aren't made for a charitable purpose and or if certain specified IRS procedures aren't followed. There are also practical day-to-day aspects of grant making that foundations must attend to. For instance, foundations must decide whether some or all of its grants, such as those over a given amount, should require internal approval, perhaps by a committee or a particular officer. Another practical grant-making consideration is whether to solicit requests for funding charitable projects. For example, a foundation interested in funding research on solar energy may find it difficult to find projects to fund. In that case, the foundation may choose to welcome external requests to fund solar energy projects. If the foundation decides to invite those funding requests, it can do so on its annual return, the 990-PF, in which it can specify the nature of the funding requests it's interested in receiving. Downside to soliciting requests is that sometimes the foundation may receive requests that are totally unrelated to the type of projects that the foundation wants to fund, and which it said it was interested in funding. From a more technical standpoint, the foundation will need to conduct basic charity research to determine the tax status of potential grantees before dispersing grant funds. That's because special oversight procedures are needed to be followed, again, if a grant is made to an organization that's not classified by the IRS as a public charity. Many foundations are surprised to learn that potential grantees like Rotary clubs, libraries, police benevolent associations, not all of them, but some, and even other foundations aren't classified by the IRS as public charities at all, triggering the need for that special oversight to avoid penalties. Lastly, once grants are approved, someone will need to be responsible for processing each disbursement. And some foundations like to include some level of monitoring or impact measurement in their granting process, such as requiring one-time or periodic reports from grantees, which would also need to be tracked. And as I mentioned earlier, foundations must satisfy a mandatory annual 5% payout requirement to avoid a violation. Therefore, it's important to track throughout the year which expenditures, grants, and certain qualifying expenses count towards meeting the 5% payout requirement, and how much more the foundation must distribute before year-end to avoid penalty. As for investments, the foundation's board, as stewards of the foundation's assets, has a duty to oversee the foundation's assets and to ensure that they're being invested prudently. Any prospective investments must be carefully reviewed beforehand, and its portfolio should be reviewed regularly to see whether adjustments need to be made. In a similar vein, the foundation will want to ensure that its accounts are reconciled on a regular basis, ideally monthly, to ensure accurate records of transactions and assets are maintained. This will be important for return preparation down the line, which includes calculation of the foundation's payout requirement for the following year. Federal and state filings. Keep in mind that aside from engaging a professional to prepare the foundation's returns, as I mentioned earlier, the foundation will want to track deadlines for such returns and ensure that someone, whether internally or externally, is also taking care of the state corporate filings. Those might be with for example, the Secretary of State, the Attorney General, or the State Tax Board. Now that we've gone over some key considerations that go into starting and running a private foundation, let's talk about what happens if the board concludes at some point that the foundation, as currently structured, is not quite working out. One alternate route that a foundation may choose to take is converting to public charity tax status. The charitable deductions that a donor may take for contributions to a public charity are typically more favorable than those contributions are made when they're made to a private non-operating foundation. Additionally, the compliance rules applicable to public charities generally are more flexible than those applicable to foundations. However, converting to public charity status is not as simple as just checking a box on a return. The foundation has to notify the IRS beforehand of its intent to switch over to public charity status, and then prove to the IRS after 60 months have gone by that, in fact, the organization met the public support test that public charities need to satisfy on an ongoing basis. The foundation has the option of requesting an advance ruling from the IRS with respect to its public charity status, which would relieve the foundation from having to pay the nominal foundation excise tax during the 60-month conversion period and enable donors to rely on that ruling in making contributions to the entity during that period. Note that if the foundation fails the public support test at the end of that 60-month period, the foundation has to pay the foundation excise taxes for any year in which it failed the tests, and also when an advance ruling is granted, the foundation is required to sign an agreement with the IRS that holds open the statute of limitations so that the IRS can go back and collect taxes from tax years that otherwise would have been closed. Although a foundation that hasn't requested an advance ruling will be required to pay foundation excise taxes during that 60-month period, it may request a refund of those taxes at the end of that period if it's ultimately successful in gaining public charity classification. If the foundation is successfully reclassified as a public charity after that 60-month period, its status as a private foundation is officially terminated. Now let's talk about the possibility of simply converting from a non-operating to an operating foundation or vice versa. Unlike converting from a private foundation to a public charity, converting from a non-operating foundation to an operating foundation is pretty straightforward from a procedural standpoint. There's no need to notify the IRS in advance. The foundation can simply fill out the applicable sections of the 990PF and meet the required operating tests. Although there's no requirement that the foundation obtain an updated determination letter that reflects its operating status, many foundations choose to request one anyway because they want to provide assurance to donors who are leery of making donations to a foundation and taking the more favorable deductions without proof of the foundation's operating status. If an operating foundation fails the applicable test, it defaults over to non-operating foundation status. There may come a time when the foundation is either ready to call it quits, or the board realizes that it may make sense for the foundation to split into two or more foundations. If the foundation is looking to terminate its foundation status for any reason, it's important to be aware that it may be subject to a massive termination tax depending on the circumstances. The termination tax, if owed, is equal to the lesser of the value of the organization's net assets when notice of termination is given by the foundation to the IRS, and the aggregate tax benefit, which in brief is a tax increase that would result if all substantial contributors to a foundation had not been allowed to take their charitable deductions for their donations, and if the foundation's investment income had been taxed at normal income tax rates. Fortunately, the foundation will not owe a termination tax if it simply makes sure that it has no assets left when it provides informal notice of termination, or it distributes all of its assets to a specific type of donated public charity. or it successfully converts to public charity status, as we already discussed. Conversely, a termination tax will be owed if the foundation voluntarily terminates its foundation status, even though it still has assets on its books at the time of notification, or if it involuntarily has its foundation status stripped away by the IRS due to willful, flagrant, or repeated acts or failures to act, giving rise to these various foundation violations. Now that we have a general idea of what to expect during a foundation's life cycle, let's take a look at a very specific question that arises for some foundations, namely whether and how to compensate those serving on the foundation. Although the very thought of it can be intimidating for some, it can be done compliantly if approached carefully. And here we have the code word, folks: compensation. Make sure to put that down on your survey to get your CLE credit. Compensation. Okay. So let's explore some of the pros and cons commonly cited to by private foundations when it comes to compensating officers, directors, and trustees. A common argument for paying compensation is that not everyone is wealthy to work on a full-time basis for no pay. That's just the reality. The foundation may be unable to attract and retain qualified candidates if it's not willing to pay reasonable compensation. But by way of counterpoint, some founders are appalled at the very notion of paying family members for their service, which they consider to be an honor and a privilege, and they're mindful, very much so, that every dollar spent on compensation is a dollar less for grant making. When considering whether to compensate board members, it can also be helpful to consider alternatives to compensation. When I say board members, I mean officers as well. So, for example, a foundation might allow each board member a certain amount of annual discretionary grants, giving them the opportunity to have the foundation support causes that are important to them. Another alternative could be to offer grant matching, whereby the foundation would match the board members' personal gifts to other charities up to an annual cap. Another option could be for the foundation to encourage its board members to volunteer on the boards of other charitable organizations by making grants to those charities in honor of their volunteer board service. Let's bear in mind that in each of these instances, ultimately, the full board is responsible for approving the grants and ensuring that the recipients are eligible grantees. Still, these alternatives encourage foundation board members to continue to develop and support their own causes and interests, while sending a clear message that the foundation values the individual's time and commitment to the nonprofit sector at large. If the board decides that some or all the board members or others serving on the foundation should be compensated for their work, the foundation should craft compensation and reimbursement policies. Those policies ideally would cover the following: the rationale for paying compensation and reimbursing expenses, job descriptions, including duties and responsibilities for the positions to be filled, which expenses will or will not be reimbursed. For example, I can't believe I actually had this as an example, but I can't make this stuff up. Dog sitting and babysitting costs incurred while attending board meetings are not reimbursable. Policy should also include who decides how much compensation to pay and who approves reimbursements. That might be a committee of the board or one or more outside advisors to the foundation with respect to compensation. Of course, there's an inherent conflict of interest when the board wants to determine compensation for themselves or for family members serving on the foundation. If there's no independent unpaid board member, the foundation should consult with counsel. In some cases, we've seen counsel set up an independent advisory panel for the purpose of making an unbiased recommendation to the board with regard to the reasonableness of the proposed compensation arrangement. Because of the actual and potential conflict of interest that can arise when compensating board members or officers of the foundation, the board should ensure that its procedures for determining reasonable comp is in compliance with the foundation's conflict of interest policy. Let's pause for a moment to put the rules around insider compensation into context. The rules that govern foundations today are largely the result of the Filer Commission in the early 70s. Those hearings led to a perception that Some foundations were being used by some bad actors to further their private interests rather than the public good. For instance, in some cases, foundations were used to lend money or rent space to family members or family businesses, to hold large ownership positions in family businesses, to pay large salaries to family members, or to grow their endowments, meaning they would just let the funding in the foundation just sit there in their coffers and never actually make any significant grants into the charitable sector where that money could do some good. The common denominator was that in some cases, the individuals and families who funded foundations lost track of the fact that they no longer owned the funds after they were donated to the foundation. While the family members may have retained control over the donated funds as the foundation's officers and directors, some lost track of the fact that their roles had shifted from owner to steward. And as stewards of the foundation's assets, they needed to put the foundation's interests ahead of their own and their families. In our experience, most foundations don't pay compensation. Indeed, many officers, directors, and trustees consider, as I said earlier, an honor and a privilege to volunteer their time and service. Nevertheless, again, a few bad actors can bring much unwanted attention. As a preliminary matter, a foundation should check its own charter documents to ensure that they don't outright prohibit the payment of compensation to officers, directors, or trustees. Also, especially foundations that are formed as a trust, a foundation should consider consulting counsel to rule out the possibility of a state law cap on trustee compensation. Of crucial importance are the practical concerns that arise from excessive compensation, such as reputational damage, and for some larger, high-profile foundation, unwanted media attention. No one wants to be in the news. Even before the foundation rules were rolled out in the late 60s and early 70s, private inurement doctrine prohibited any part of the net earnings or assets of a tax-exempt charitable entity to be used to benefit private individuals. This prohibition of private inurement encompasses the payment of reasonable compensation to insiders, including officers, directors, and trustees. And any amount of inurement, theoretically, is potential grounds for revocation of tax-exempt status. In addition, we have what's called the private benefit doctrine, which requires tax-exempt charities to be operated exclusively for charitable purposes. A charity's activities may not serve the private interest of any individual organization, not just insiders. The penalty for violating the private benefit doctrine is, again, theoretically, revocation of tax-exempt status. But, concluding that these prohibitions weren't enough of a deterrent, Congress passed a series of rules targeting, at least in part, individuals receiving unreasonable or excessive compensation and other benefits from their foundations. The Internal Revenue Code imposes penalties on a private foundation's taxable expenditures, which I mentioned earlier, and those include expenditures that don't further charitable purposes. Now, in this context, a payment that's unreasonably excessive isn't necessary, and by its very nature, doesn't further a charitable purpose. Accordingly, the regulations explicitly provide that unreasonable compensation will result in a taxable expenditure unless the foundation can demonstrate that the payments were made under a good faith belief that they were necessary and consistent with ordinary business care and prudence. If the foundation pays compensation found to be unreasonable, the foundation could be subject to a 20% taxable expenditure penalty on that portion of the compensation found to be unreasonably excessive. Not only that, but if the foundation manager agrees to pay unreasonable compensation, knowing that the payment would be a taxable expenditure, that manager could be personally liable for a 5% penalty on the unreasonable portion of the compensation paid. Furthermore, the taxable expenditure rules and regulations require that the violations be corrected, which could require the return to the foundation of the amount of compensation found to be excessive. The IRS can even hammer home, although it rarely does in my experience, a 100% second-tier tax penalty if the violation isn't corrected in a timely manner after the IRS notifies the foundation that this must be corrected. Similarly, the IRS can impose a second-tier tax penalty on foundation managers who refuse to correct the violation. On the self-dealing front, by design, the self-dealing rules are pretty strict, as the IRS isn't authorized to forgive a self-dealing penalty even for reasonable cause. In fact, when the penalty is triggered, it doesn't matter whether the transaction was fair, or even whether the transaction's terms were favorable to the foundation. Perhaps most attention-catching, however, is the fact that when the self-dealing penalty is triggered, it's the insider, not the foundation, that must pay the penalty. These rules likewise prohibit a foundation from indemnifying an insider for the self-dealing penalties, because if it did so, that would lead to a second penalty. While foundation managers can be hit with penalties for participating in a transaction or payment that they knowingly, again, will result in self-dealing, an insider can trigger these penalties even if the insider doesn't know that the transaction or payment is prohibited under these rules. In other words, ignorance of the rules is no excuse for an insider when it comes to self-dealing. The self-dealing statute, however, provides an important exception for payments of reasonable compensation to an insider if certain conditions are met. If a foundation pays unreasonably excessive compensation to an insider, that insider will be subject to a 10% penalty on self-dealing, but not on all of the insider's compensation. Rather, the penalty will apply only, again, to that portion of the compensation that's found to be excessive. So, for example, if reasonable compensation is $100,000 and the person is paid $175,000, the penalty would only apply on the $75,000 excessive piece. In addition to paying a self-dealing penalty, the rule requires correction, which typically means the insider's return to the foundation of the unreasonable compensation received, which can be crushing if the compensation arrangement spans several years. The IRS can even reassess this penalty for each year that the violation goes uncorrected. If the insider refuses to comply with the IRS's demands for correction, the insider could be subject to an additional second-tier penalty on the unreasonable compensation. What's more, if prohibited transactions or payments are never cured and the foundation repeatedly and willfully violate the rules, the nuclear option that's available to the foundation is a termination tax, which is, as I mentioned, is equal to the lesser of the tax benefits the foundation and its contributors ever received, or all of the foundation's assets. Well, who is considered a foundation? Now, bear in mind that the self-dealing penalties are triggered only when the person being compensated is an insider. That's why it pays to know who's considered to be an insider. And you see here the cast of characters that you'd naturally expect to fall within the ambit of an insider. Generally, we have the folks running the foundation's substantial funders, and certain family members. Family members include close family members, including parents and grandparents, and children and grandchildren, but for these limited purposes, they don't include nieces, nephews, aunts, uncles, cousins, or even siblings. Now, the self-dealing rules, again, specifically apply to a foundation's payment of compensation to an insider, but again, the exception applies for compensation or payments for personal services, and those that are reasonably necessary to carry out the foundation's purposes, as long as the compensation isn't excessive. Unfortunately, neither the statute nor the regulations define the term personal services, and they don't include either a de minimis threshold or a safe harbor. All the regulations do is provide a handful of examples of services that are personal services, and those examples cover only legal, investment, and banking services. According to the tax court, personal services are those that are essentially professional or managerial in nature, and the term is generally understood to include professional and managerial services rendered in the insider's capacity as an officer, director, trustee, or executive director of the foundation. By contrast, certain operational services like landscaping, property maintenance, security, and janitorial services have been determined not to constitute personal services. And remember that even if an insider's compensation is reasonable, the self-dealing penalties can be triggered if the services rendered aren't considered to be personal services. So the center of gravity here is the reasonableness of compensation. To determine what's reasonable, the self-dealing regulations reference the regulations under Code Section 162, which governs the deductibility of compensation as a business expense. Under those rules, known informally as the like rule, reasonable compensation is the amount of compensation that would ordinarily be paid for like services by like enterprises under like circumstances. And that's why foundations typically rely on salary and compensation surveys that are compiled by knowledgeable compensation consultants to determine reasonable compensation levels. Using survey data, though, is something of an art, and we'll maybe spend a moment talking about that as well. Aside from surveys, there are many other factors that can be relevant in setting comp, like written job offers from similar organizations, work credentials, experience, special knowledge, skills, hourly commitment, and the foundation's geographical location. You see here certain factors that are used by public charities to determine reasonable compensation, and the regulations provide public charities with a safe haven option that's unavailable technically to foundations. The safe haven provides that if certain procedures are followed, the compensation paid by a public charity to one or more of its insiders is presumed to be reasonable, and the burden is shifted to the IRS to rebut that presumption. Although the safe haven isn't technically available to foundations, the industry practice has been to satisfy these procedures to establish and document the reasonableness of compensation. Under the regulations, a rebuttable presumption is established that the conditions shown here are satisfied. As I mentioned earlier, using the compensation surveys is more of an art than a science. The survey data will be organized by position, such as CEO, grant officer, investment officer, and the like, and then by various cuts or subsets of the data. The grail is to use the cut that's as close as possible to the foundation's own circumstances. For example, a foundation could be located in the Northwest and have an annual budget of $500,000 with 2 grant officers and a CEO with 15 years of experience. Now, the published data might include each of these cuts, but not necessarily a cut of all the factors taken together. Adjustments may be necessary if the foundation is located in an area with a high cost of living, like San Francisco versus Wichita. If the survey is dated, it may also be appropriate to make adjustments for inflation. The compensation committee must also decide which quartile to use in determining the market. The most common and conservative approach is to target the median of the marketplace. The foundation may be justified in targeting above the median if it can make a good case for needing special skills, experience, or leadership qualities. Any foundation targeting above the median should be prepared to explain its decision. And in a similar vein, it may be appropriate for a foundation to pay comp below the median to a person who's inexperienced. Just to wrap up, there are some situations the foundation will want to avoid as they can raise red flags with authorities. First, the foundation should avoid paying more than one person for the same job, although splitting one position between 2 or 3 people may be okay. Additionally, foundations should be careful not to compensate for full-time salary positions where the foundation simply doesn't have enough activity to justify it. In such cases, an hourly arrangement might be more appropriate. And lastly, as we've seen a lot over the years, the foundation should avoid paying a seemingly low salary where the hourly commitment is also low, but not proportionally so. For example, if a foundation pays a salary of only $15,000 a year for only 1 hour per week, that's the equivalent of $600,000 salary when annualized. Put another way, that's nearly $300 per hour. Sign me up. And as we come to the end, and I believe this is the last slide, although nonprofits are, again, increasingly trying to offer competitive salaries to attract talented leaders, it's important to keep in mind that compensation for nonprofit employees, even at the C-level, does not typically match that of the for-profit world. Although, also, it may sound counterintuitive at first, the foundation may be best served to avoid data from headhunters or recruiters, because that data likely won't be representative of the nonprofit job market. And be mindful of the total amount of compensation being paid to all disqualified persons combined. If that amount is very large on its face, it could also trigger compliance concern. And the last thing I'll say is that, although not strictly a comparability issue, the amount of the compensation in relation to total assets or to annual grants is very important, because no matter how much work is done by a foundation employee, it won't be considered reasonable if it appears totally out of proportion to the foundation's charitable resources or activities. And the result, these factors alone can trigger a review by an authority. And with that, we come to the conclusion of the presentation.
Well, thank you, Jeff. We do have some questions, so let's try to get to as many as possible. First question, is a foundation in a nonprofit able to donate to the parent nonprofit? What tax considerations exist for a nonprofit owning a foundation?
So for one nonprofit donating to another nonprofit or to a parent nonprofit, so you can have an example, you have examples like that all the time. There's such a thing called the supporting organization, which is the type of public charity that tends to provide support to a supported organization. So generally, as long as the grantor foundation is giving to a public charity, no special measures need to be undertaken. But again, if it's the grantee is not a public charity, special oversight procedures known as expenditure responsibility may need to be followed.
Do you have advice on the financial level advisable to establish a private foundation versus a donor-advised fund?
So that is a classic question. I probably get that 2 or 3 times a day. So it depends. It really depends on who you ask. So look, I'd say there's some folks that I've seen that weren't quite ready to commit to donating maybe millions of dollars into a foundation. They wanted to dip their toe in the water. So they may have started on the small side, say between $300,000 and $500,000, and just try that out, see how that goes. And then when they're happy and they like the way things are going along, they'll fund it with more. I'd say it's common, although there are a lot of foundations under $1 million. I'd say it's more common, to see in the minimum of like maybe 1, 2, maybe even 3 million. But again, it depends on who you ask. Sometimes it might be a placeholder because you might be expecting a bequest or some sort of liquidity event, and you want to just hold it open for when that liquidity event occurs.
Did I hear correctly that nonprofit corporations can take charitable deductions for grants, but trust form charities can take charitable deductions for grants?
So what I was saying is that when it comes to the unrelated business taxable income, that's UBIT. So the unrelated business income tax is in the for-profit income tax regime. And so just like if I personally or a U.S. corporation that's a for-profit were to make a grant, a charitable gift to a foreign charity, they're not going to get a U.S. deduction for that for their income taxes, for income tax purposes. So I'm saying that if you have a foundation and you make a grant to a foreign charity, again, it may be great, and as long as you follow the procedures when they're required, but it won't count as a income tax deduction on your UBIT tax return. That's what I was saying.
Okay. Can you terminate a private foundation by donating funds to a donor-advised fund?
Yeah, so sometimes foundations will do that. They will, at some point in time, make a contribution to a donor-advised fund, either maybe to facilitate these annual discretionary grants. I said earlier that one alternative to board comp would be setting up discretionary granting for board members or officers. Sometimes when the board member or officer may want to be funding something that's not necessarily aligns with the foundation's charitable mission or purpose, like let's say the foundation is all about the environment and someone wants to do something about feeding the hungry or whatever. Sometimes it might be appropriate to fund a donor advised fund and let the officer or director make grants out of that account. But yes, and certainly a foundation can make a grant to a donor advised fund, which is an account at a public charity, after all.
All right, let's just squeeze in one more question. What are considerations for a 501c3 nonprofit donating funds to a 501c6 nonprofit?
Yeah, so we see this all the time where we're talking about a grant from I'm talking specifically about a private foundation to a C6, which might be like a business league, for example, or a Rotary Club, which is an exempt organization, but not one that's dedicated exclusively to charitable purposes. So in a case like that, a foundation, if there is a specific charitable project or program that the C6 is running, and the foundation wishes to support that particular project, the foundation can exercise expenditure responsibility, which is a series of due diligence and oversight over the expenditure of the grant funds, including a special grant agreement, to make sure that the funds are spent as intended and reports are coming back to the foundation accounting for the C6's expenditure of those funds on the project.
Okay, well, it looks like we are out of time. We will have the recording of this webinar available in a couple of days if anybody wants to see it or wants to forward it to a colleague. Again, I'd like to thank our speaker, Jeffrey Haskell, for his amazing presentation. And also I'd like to thank Foundation Source for sponsoring today's webinar. Once you leave the event, a short survey will pop up in your browser window, and we'd appreciate it if you'd share your feedback on this event so we can continue to provide you with interesting content. And also for those attorneys in the audience who want CLE, don't forget to put in the code word. On behalf of Trust and Estates and Wealth Management, have a great day.